Hello. Are you going to introduce us or should I do it? Okay. So it had been a very long day, a very interesting day also, I hope. For me it was. So it's nice to see that there is still surviving people at the conference. So let's start. So first of all, this is a panel about using data in very large, very important financial corporations. And so therefore, since we don't have a lot of opportunities to hear about that, I'm going to try to speak less and let people speak more. So let's start with introducing yourselves, please. So say something about what you're doing, not too short.
So my name is Filip Bovan. I am a former investment banker from JP Morgan from the private side, more doing M&A, IPOs, and this kind of consulting services for big companies. And now I'm also founder of SM Business School here in Belgrade. We offer an executive MBA program. So I've switched from investment banking and moved to SM. So it will be really glad to be here and provide some examples of how we use data in investment banks, but also in a business school.
My name is Milenkovic. I've more than 25 years in financial markets as a trader, execution, buy and sell side risk management. The last 17 years I've spent with Credit Suisse, which is not existing anymore. It's now UBS, and I share the thought with Philip to add some value today to give you an insight what we do with data and data management within asset management, but as well in investment banking, just from a different angle.
I'm the program director of Mastering Computational Finance here in Belgrade and the program director of Cryptica, the conference that has horrible title, I guess, according to the previous guest. So here we can go.
Good evening. My name is Marko Jevremovic. I have 12 years of experience working as a quantitative researcher at UBS, which is the biggest Swiss bank, and JP Morgan, which is the largest US investment bank. So I was quant in both of these roles, although different types. So in the first part of my career, I was dealing with the portfolio of the bank, with all of the stochastic calculus models across all major asset classes, whereas at JP Morgan, we built from scratch a data analytics platform for one of the major internal businesses at investment bank.
Good afternoon, everybody. I would like to thank to Branko and Cryptica for organizing this event and to everybody here who's in attendance. My name is Vladimir Aleksic. I've been working in investment banking for the past 15 years. My day-to-day is working with data, quantitative-driven models. My job is designing trading strategies that are data-driven. It's a big passion of mine, and I'm very excited to be sharing some of the insights and experiences with everybody in the audience this afternoon.
And by the way, these two gentlemen on my left are also members of our advisory board at the MCF program, so I'm very happy to have them to guide us not to make so many stupid decisions. So let's start with you, Vlado. Maybe you can tell us on your day-to-day basis, how do you use data and what are potential pain points?
Yeah, sure. So I think it's interesting that we start from my side where we are at the lowest point of using data on a big scale. Because for M&A purposes, when you do evaluation of a company, you are using reportable figures, not so much of public data that is available. But we're trying to use No? Yeah, now it's good. Okay. So let me just share an example of how do we use data for valuation purposes when we value companies. Generally, we start with reportable figures, and the kind of main pain point we have is that in different teams across the globe in the same company, people value the same company with different strategies. So instead of having a kind of one platform where we input data and then another team, another location can use that to value in the same way the company, you have different teams valuing it with different strategies, and you come up with a valuation of, let's say, 1 billion in one team and maybe 1.5 billion in another team. So that's one of the main pain points when we speak about data, because we are not inputting the data in the consistent way across the globe. So we are not even on the range of using more complex models, AI or algorithms. It's just the basic thing you need to be sure that the data you have inputted in the system is consistent and it's done consistently. So I think there is a range from starting with raw data, going to using AI as the ultimate goal of, let's say, big data. We are in investment banks in the part where we do consulting on M&A IPOs. We are at the beginning where we try to make sure that the data is at least in our platforms. And then the next step would be to actually go towards using some models where we can use predictions and use AI. So now we are kind of in the basic part, but still compared to, let's 10 or 15 years ago, it has moved a lot where, I mean, 15 years ago, everything was still done on very basic models. Something was done even on papers, some valuations. So we moved, but still, in terms of what is existent, what AI tools you can use now with data, we're at the low end of using the data. So I think there is room for improvement, but it's going in the right direction because investment banks are having initiatives to collect those data that is public and put them into systems. The main kind of the main goal there is that we value the companies in the same way across the globe when we speak to clients. So they don't speak with other people and they have different views. So that's kind of the main goal.
Okay, sure. Yeah, data is important as well from an asset management perspective. We have different layers. I mean, first, the data, you have data from a portfolio management perspective, then you have data from a markets perspective. So you have to find a way how we can combine these two, giving for an example of the issues. You have different type of holidays in different type of the worlds, then you have different type of weekends, then you have lack of data, then you have the whole topic about quality of data, then the sheer amount of data. Just to give you an example, under my leadership, we have $300 billion in all assets you can imagine across the globe. So the sheer size of data. And then you have different levels of automation or AI, machine learning levels, which you can apply. And one level for the portfolio management or risk side was really to find something similar. What Bovan was mentioning, optimization is a huge topic for portfolio strategies and how to invest, deploy the money. Another important topic, given that we had our own execution desk, what we did with AI to build what we called an algo wheel, which is basically how to deploy the orders you want to put into the market the most efficient way. That means not to move the market too much up or down, given the significant volume you were investing on a daily basis. And then last but not least, on the risk management side, where we're far at the beginning was mainly really focusing on how you can improve the whole monitoring, reporting piece, data quality I've mentioned, and then at the end of the day, think about smart ways of again, AI, machine learning to build something forward-looking, which everybody's dreaming of, given the sheer amount of data what we have.
So how about you, Vlado, from, on the same question? What do you say?
Yeah, so in banking, every team, every desk uses all sorts of data, from like raw market data to economic data to balance sheet data to weather forecasts to satellite pictures that are recording how much, what's the traffic in, on certain roads and stuff. So all these types of data is used routinely across the different desks. In my case, I typically use just time series data in order to create trading strategies. So number one is price data, and with price data, the standard of the industry is pretty good now. That there is no pain using that. It's readily available and it's very prolific. There is a bigger issue with economic data, how economic data is used. And there are a few pain points. So I would say I can think of 4. So the first pain point is that typically some data is backward-looking, some data is forward-looking. But to go on to talk about the backward-looking data, if somebody tells you the inflation today is 12%, and today is November, that typically means that inflation for October, year going back, is 12%, right? So it's very backward-looking, whereas you need to have data that tells you something about what's the state of the world today. That's number 1. Number 2 pain point would be that economic data typically comes with various frequencies. So you could have GDP is published quarterly, inflation is published monthly, then you have employment numbers that are published weekly, and there are various ways of combining data with different frequencies in order to have a good piece of information to make decision today for something that happens in the future. So that's number 2. Number 3 would be, let me think. So number 3 would be, let me look into my, just one second. Number 3 is that, a very big problem is data revisions. So say that there is, let's talk about inflation again. There's a number that is published by the government today, and that will be a flash number, the first estimate. And then they come back in about 2 or 3 weeks time, and they publish the real number, right? From that point on, you do not know anything about what was the first estimate, right? So any revisions that come as governments look into the data better, the revisions override the original, so you do not have the point in time. And you do not have what was the information, the point in time. So when you're backtesting a certain strategy, right, you only have the data that was revised later. And probably you needed something that was known at the point in time when you were backtesting whether your strategy was good. Okay? So let's leave it there. But there are a few pain points that are present, and the whole industry is trying to solve those pain points and make the data good at a point in time, same frequency, daily, that gives you information about what could happen in the future.
You have a specific quant perspective, so can you tell us more about that?
Sure. So clearly it's useful to view investment banks as a collection of plenty of businesses. Primarily, we have two main divisions. We have markets divisions, which are your traders as you have seen them in movies. And you have investment bank, which is what Philip was working on. So basically, M&A deals, IPO, etc. Within markets, you have different type of traders. So you have for each asset class, for derivatives, and each of them are a different data journey, so to speak. So if somebody would ask, okay, so where are we now with machine learning? It really depends. So I will walk through this, let's say, typical high-level steps for a business where there is nothing in place. Let's say you want to build data analytics platform from scratch. So in a typical business like that, and I'm reflecting on some of my experiences there, you still have data which is not clean. You have databases which are not synchronized. You have plenty of people doing various reports. So the first step is foundation. So, and that's primarily tech job to kind of redo the architecture of all data flows, etc., and understand all of the columns and make those more efficient. In some of the banks, I'm aware of the stories where the whole bank migrated to cloud, and that made everything consistent, right? The second step would be automation, right? So all of these reports that people were creating manually, ideally you would have to automate, and nowadays that's not necessarily even something that even tech or quant can do. Now with the advent of Python and Jupyter notebooks, we have front office, we have traders themselves codifying the reports. Clearly, this is not done always in the most performant way. This is where then quants step in and tech step in. So the automation is the next step. And this is really the necessary step because we have a situation where people that have been there for a long time, they have seen the numbers, they have some intuition about numbers, but really until everything is automated and you can see the full history, you cannot talk about data analytics. Then the third step would be, let's say, some kind of revision of heuristics. So Philip was mentioning here that typically in an M&A deal, you would have, let's say, large spreadsheets with quite a few assumptions, and some of these assumptions are, let's say, based on some level of experience, some approximation. However, now you can make a pause and say, okay, so this particular variable, which is our assumption, which is used here, do we have data to actually justify this number? So then you get into territory where you essentially start building mini models where you estimate these key figures, and trust me, some of these key figures can really tilt valuation of deal quite a bit, right? Because you can have various covenants which are triggered at specific situations. And only then when we made everything consistent, we have everything mathematically sound, we have good enough history, only then we can tinker with machine learning. So that's where machine learning comes.
So, great. May I ask you, Adam, so in the market business, how would you estimate is the readiness of people to work with data?
It changed significantly for the last, I would say, 10 years ago, or since 2007 and 2008. Why then? Because that was one of the biggest crises in the financial markets you went through. And then people suddenly identified, oh, we think we talk about the same, but we do not talk about the same because we have complete different types of what we discussed already, types of data sets, frequency, etc. And I think the other part was really identifying ways how we can streamline ways of doing things by automating more things. 20 years ago, we used Visual Basic, as you might imagine, but you cannot use that today. And so that basically, through the crisis, the need was generated to review the data, the platforms, the systems, and then start working more and more with data because people identified, and it was mentioned yesterday, data is the new oil, so to speak. And if you have an advantage in data, and you can see that a lot of in the past hedge fund strategies, for example, the high frequency trading guys, why they are making so much money? Because they have an advantage in the speed of data, etc. And that was basically as well identified as part of the investments, that you could have a significant edge against competitors if you do it right from a data, AI, machine learning, etc. perspective.
Okay, so how about Vlado? Same question.
Same question about the readiness of the data. So, I mean, I'm going to have a very short one here, and that is going to be that say that you want to create a quantitative strategy in FX, data is there, right? Data's been available forever, and that's routinely done. But then another client comes and says, hey, how about you try to offer me something that combines all the asset classes, you apply the same algorithm, and let's see what we're going to get. And then if you don't have your data readily available in the system in the same format ready to use as you have the foreign exchange, then you're in a problem. You can't really offer that. And some of the companies manage to profit and take advantage of their readiness, in that they had, also in banking, you know what happens is that various parts of the bank, they run different systems, and different systems have data written in different formats, and not everybody can access those systems. And if you have everything in one place, then you have a really, really big competitive advantage. You can offer everything easily with the same way you look at, I don't know, risk reports, the same way traders have just the flow to trade them. risk people have this, a good and easy flow to analyze the risky exposures, and you can run your analytics. So readiness is a big, big competitive advantage and should not be underestimated.
So, Marko, can you tell us a little bit about what is your assessment, how people use machine learning, if they use machine learning a lot? They talk about it, but how do they really use it within, the finance, this top finance?
So first I have to say people call a lot of things machine learning. So maybe I start with the one that people typically associate with machine learning, and that's neural networks. So actually one, let's say, first production use case of neural network that I'm personally aware of was that when JP Morgan went live with equity execution algorithm, and in that case, it wasn't even the whole algorithm, just neural network, but of course something that was built for decades. They just pick one particular tiny part of the process, and they did something which is called Q-learning, which is one very deep neural network, and that was pretty much, let's say, the first pilot version of that significantly improved profitability of the live production algorithm, which was developed in decades, and that's kind of inspired people to look more deeply into it. It would be quite dangerous to have the whole algorithm be a neural network because, of course, as a bank, they have to be aware of their risk limits, and they need explainability as well, and that's actually quite a major thing in finance. However, if you look broadly in finance, you can, as I mentioned, view it as a collection of quite a lot of different businesses, all of them with quite a different set of data. And this data is not necessarily what you would call a equivalent of big data as in big tech company. In big tech company, typically we would have one large problem which they put 100 people on to solve, let's say optimize advertising revenue or something like that. Whereas in finance, it's quite split. So for those problems, actually, it turns out that it's not really necessarily neural networks which are showing the best results, but it could be something like tree-based algorithms, which I think people perhaps underestimate, but it is showing better results. The other example of a deep network that I'm aware of, and actually it's more of the avenue of the future research, is so-called deep hedging. It's my previous boss, or my boss, won an award, Quant of the Year, for that, which was published. So it's effectively, can we, instead of assuming Black-Scholes model for pricing call options, is it possible to somehow have neural network understand, based on the quoted call prices, that it somehow follows some kind of Black-Scholes similar approach. The initial results are positive. It's still not, I don't think it's fully in production, but first papers are written. And some of the advantage of this approach is that you could better, for example, take into the account the impact of transaction cost of the overall option prices.
So, Filip, to switch gears completely, I can't help it. So you switched from working in London in the investment bank to running your own executive MBA school here in Serbia. How is that impacting your life, and also how do you work with data? Is there any challenges with data here in Serbia? Facing?
So I think we are using, let's say I've switched gears from an investment bank to a business school and switched gears to using less data to much more data. So in terms of, we were quite standard at using, balance sheet reports, analyzing valuations of companies, and also backing, as Marko said, some assumptions in terms of some different rates that are very important in valuing a company. However, when you run a business school, you have different modules, different learnings that you need to provide, and you need to look for the best data available, because giving good quality education to executives is not that straightforward. Data is available, information is available, and if you want to have some added value to the already available information, you need to look and be very smart to look for good examples, good new trends, what is happening, and really screening and searching for. So that's one part, is really providing high quality education. The other part is kind of just finding people who are interested, finding professors who are interested, finding mentors, finding coaches. So if you look at that point in terms of creating a business and finding the right people, if you use data and you try to be very structured in looking for those people, you will find them. For example, you want to find one good professor in the world, you need to screen for 200 to 300 professors. And that's working with data. And it's in an Excel, have 15 columns, 20 columns of different criteria. You have 300, 400 professors. And then by visualizing those data, you can. So actually, you can apply data in any business. And I think you need to follow a structured process. And it's always good to have more numbers and more data to be able to find what you're looking for.
Wonderful. So now I would like to invite the audience to ask questions, if you guys have any, so not to overwhelm you with our talking. Question. So can somebody bring the...
Yeah, I think that all of us here are either current or future or ex-MCF students. So I have to say it's really pleasure to have experience to share some, to listen to you guys and to see something that we haven't been able to see before. I mean, the experience of you all, it's incredible. So I have a question that is more like advice that we probably all of us here wanted to ask you as someone who would like to pursue his career in investment banking, like where to start, what should be our, step by step, and to achieve this goal.
Okay, so first to ask, what kind of role are you applying for? Are you applying for are you applying for investment banker? Are you applying for trader? Are you applying for quant? Are you applying for any role? Because the avenues could be different.
Well, in my opinion, and in my case, M&As and investment banking generally, valuing companies and everything was really interesting to me.
Yeah, so that's a more question for me. Always start with education. The world is built on filtering systems where banks will outsource filtering of people to educational institutions. So you need to make a difference with education. That can be doing like a program of Marko, which is getting, I think now worldwide reach, and people are hearing about it. But also maybe some, I know people do also the CFA if they want to stand out. So it's really first being profiled with education, because they outsource profiling to institutions. And they generally only look for kind of the best schools when you apply. That's one thing. And the other thing is networking. So you need to be present. And each time there is a social event that an investment bank is doing, you need to apply, because they have also part of their website where they provide all these events and you can apply for. So it's really kind of networking and getting to know people who are working. And then when you mix both, you have a chance at being interviewed. That's the first point. And
yeah, actually, I'll reiterate the second point Philip made. I think it's underestimated, but I've seen it in practice. So basically, what happens abroad is you would have companies, let's say, go to target universities. I don't know, UCL, LSE, Cambridge, etc. They would hold a talk. They would send somebody there. And actually, they would look who would approach them with questions and who is genuinely interested. And they would actually ask them, okay, can you please leave us email? And some of these people that they deem, okay, so I can see that this person generally wants to work, and I can see that it might be a good fit, because clearly the personal touch is, I think it's quite important. some of these people directly get invited. So
But if you're not, at
If you're not
those
there,
ch- if you're not at the top 2 or 3 schools in the world, but you are in Belgrade, then what would you do?
then I think first there have to be a better funnel.
Well, then you talk to some people that have connections, right?
Yeah,
So
perhaps, yeah.
I think
Or you start with companies like the Big Fours here. I've seen people start at Big Fours here and move up, do M&A here, and then apply for some roles. You get kind of if you work for 5 or 7 years in a Big Four here, you will not get the same level in an investment bank. You might get downgraded by 2-3 levels. But that's not a problem. I think it's not about years. It's about just getting there. So it's also another route. But even with that, you need to network. I mean, that's just a prerequisite.
And sometimes this networking is internal, so that also means that you don't necessarily have to apply straight away for M&A role. You can apply for back office role, right? There are quite a few examples that back office moves to trading.
So may I just say the following? So together that I'm doing various educational programs here for 20-something years, and my students are in more than 60 countries now. It's certainly possible to get jobs to any good organization if, for example, you apply to internships. If you don't apply to internships, you're cutting yourself from opportunities. So I know personally 4 people that got into Goldman from Belgrade applying through internships. I don't know how many others applied and didn't get through, but these 4 I know, and so on and so forth. So, but you need to proactively try to do stuff. If you are sitting on your ass and you're thinking it would be good to get somewhere cool, it should happen, then you're not going to do much. You're going to continue sitting on your ass. But if you move, so practically everybody who moves hard, they achieve a lot of stuff. And my goal was to create good programs and to do it in Serbia. And I do it. And everybody said, you're completely crazy. Why would you not want to be a professor at Harvard? And I said, no, I don't want to be a professor at Harvard. I want to do this. And so for me, and then other people conspired to help me, like Martin here and these guys and so on. And so if you want to do something, you just need to do it. You need to put an effort. And then it happens. That's my opinion.
Nothing to add.
Thank you. Thank you. I have one question. So, can you hear me? Okay, it works now. So, one question for the data actually. So, you mentioned market data, which is kind of already really good and accessible, but what in some instances where you would need data which is kind of not easy to get, do you kind of use some methods to create synthetic data based on some small sample, or which methods actually you use for that? Yeah.
Okay, so I guess this for me. Right, so there is a big push by a few companies. Some of them are much more successful than others. There may be 1 or 2 that are standing out for just for market and for, like, trading. The key word is quantamental. Quantamental means quantitative and fundamental together. So what I'm trying to do is to use, say, backward-looking data published by agencies, governments, etc., corporations. And then, as I said, the problem is that they are either backward-looking or with different frequencies. So if something is published today, you need to wait for, say, a quarter for the next print. But what you do is you do something that's called nowcasting. And that means that you take as the last known state the last official number, and then every day you use alternative, more frequent real-time data in order to estimate what is the real-time value of GDP. And let's talk about, I mentioned GDP, let's talk about inflation. I'll give you an example, right? So say inflation is printed once a month, but intra-month you can use things like car dealership. They have car prices, used car prices. They are very important for the inflation number. Or you have rents and housing market. You have these online agencies that provide in more real time where the rental market is. Then stuff like that. So then using more frequent data combined with the official data, but also using quantitative methods to, for example, you know, some of them use machine learning in order to create a model that is going to give you a good real-time estimate. That's a big area of work. And if you're able to do this systematically across different countries, different continents, and across as many popular mainstream time series, then you have a big competitive advantage. So, you know, that's one example. We can talk after that. There are many examples, but quantamental, remember that is a trend. Thank you for your question.
Any more questions? Yeah, if not.
Okay, thank you very much. Thanks for the panelists. Have a nice rest of the day.